Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, the sheep are now awake. We're going to explain in this video. Let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. You know, we have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
Bah. All right, Bob, what have the sheep seen?
They're saying, is that a wolf coming at me? So the consumer sentiment numbers came in and people, I think they're getting it. There was also another study done, and I couldn't find it. It said people will prefer a recession over persistent inflation because inflation is insidious and it affects every single person. And I think people are feeling it now, and they're starting to tell the pollsters. So if they're telling the pollsters that it's this bad, you know it's a lot worse because everybody always lies or don't really tell you the truth. But we're getting down there again, Phil, where we're going to start approaching the COVID lows again. And this is just beginning. This problem we're having is not going away anytime soon. You should see they're pushing in and pushing through cost increase like crazy now across the board. And you're talking, I looked at the grocery store. There's some things that are up 50%, and then they're testing back with sales on some of this stuff. So we're looking at probably double-digit cost increases across the board. And in services, it's ridiculous. So I'll give you an example. So we wanted to put a ladder in, one of the pull-up ladders for the garage in one of our storage lofts. And, the ladder itself's $150. It's probably 2 hours worth of work, maybe 3 at the most. And they quoted me $800, Phil. And it's just ridiculous. And I just looked at him and said, look, I'm not putting your kid through college. I think I'll pass on it. And I think that's the problem we're having now is that people are so desperate to make any kind of money on any kind of sale, and people are starting to back off. The other thing that was interesting, and I should have got the slide too, that goes along with this, is that the government now is like saying, hey, we got to get people's wages up. So now they're raising the exempt. If you're an exempt employee, they want your minimum pay should be $800 some a week. You're basically looking at $3,200, a month, which is nearly $40,000 a year if you want to be an exempt employee. And if not, then they throw you into the non-exempt class, and you have to pay hourly and overtime. And so it's really getting to a point now where this is like the 70s all over again, Phil, where they try to do this push inflation because the costs are increasing because the government can't stop spending, and then now they're trying to get wages to match it so that people don't fall ridiculously behind. But we have a problem this time because 24% of the people aren't working.
Right.
And more people rolling off into retirement every day, and it's just going to be brutal. I think you have another slide too, don't you? So
this is the consumer confidence, which, as you guys can see, is rolling over and starting to accelerate down. And really, when it comes to all of these macroeconomic indicators, it comes down to the rate of change. So as things start to accelerate, that's when you have to really become cautious. Now, the next chart, Bob, here is, so it takes the chart we just looked at and then overlays the expectations index, which is important because, as you can see, that's not giving us any relief.
No, it's a big problem, and people are now starting to get worried. And, people are going to start pulling back. The restaurants here are no longer full, and, like I said, what's going to happen here is that people are going to start giving up on things that they don't absolutely have to have. And that's a problem for our economy because that's where most of the employment is. And you're just going to see this. Well, basically, it's like an Alzheimer's. It's a slow go away. There's no big event. There's no General Motors to lay off 30,000 people kind of event. It's just this silent scream we talked about before, where the companies are cutting back hours, or now if they're in a situation where they have exempt employees, are like, hey, I'm going to have to outsource your work, or I'm going to have to cut back on my business because I can't afford to pay you. And it becomes a death loop. I think the death loop has begun, and people are recognizing it, Phil. And I think the market kind of senses it too, don't you think?
Yeah. So I think, if we can maintain over 140, then this market will probably still be able to do what we think it might be able to do, and that is to keep going up into going towards as we get closer to the election. Maybe that's only August, or maybe that's only July, whatever. But if I'm going to watch going forward when we get these consumer sentiment reports is if we start breaking 140, and if we start breaking it with speed, you might have to reassess. Maybe whatever highs that we have in at that point might be it. You have to be realistic about this stuff, because that's basically telling you that you're about a quarter away from a recession, or an official recession. I know most of the economy is probably already feeling it and already in one, but so that's what I'm keeping an eye on. And then, the markets were sour today because of this, right? Markets held up. We had cost of employment numbers come out. Those were high. That's inflationary. But the market kind of absorbed that. But it wasn't until after the consumer sentiment came out that the markets really took a dump. And so I thought, Bob, we just take a look at the charts real quick, since things are red and people are wondering where things are headed. The most simplest thing to do is just look at the S&P 500. This is the SPX. This isn't the futures, the actual S&P 500. We ran up. We back tested. This is the 50-period moving average, this green line. And very textbook rejection here that's going on. So these typically are fairly large, and that's why we're down some points today. The other big level is this step line, is the weekly 9 EMA. We talk about that a lot. We basically had to look above and fail there. So we were sandwiched between these two levels. Now we've broken back down. So the bulls had a shot. The bears dug in up here, and now the bears have taken back control. We got a gap lower, which could send us another 20 points lower today, if the markets sell off into the close. But if you look at the bigger picture, if you look at like what we did, if you take this range here and look at the fib, right, we bounced right off the 618 on that, which gives us targets of 48.89, so under 4900 on the S&P 500, and then the deeper target would be just under 4800, and you get into some of these unfilled gaps that we had left behind, right? So that's typically what the market does. If it's in a ripper move, you're going to get a quick correction that typically will fill in these gaps. Do we get that low? We'll have to see. I think as long as we're in the month of May, you have to be careful, because you can certainly get this kind of reaction. The other thing too, if you guys look, is the liquidity is just falling off a cliff here. Now, it's not abnormal to see net liquidity do this when you have tax day or tax month. But if we don't get a turn on this at the end of the month going into May, because that's typically what we see, then you can expect this to catch down a lot. And we're not usually prices a little more sympathetic to these drawdowns in liquidity. And as you can see, we're about, from what we measure as a baseline, we're about 1,200, almost 1,300 points overvalued. So there's certainly a lot of room to come down. And so even though those numbers below that we talked about in the S&P 500 might seem like they're far away, that's actually not, outside of the realm of possibility. Then there's Bitcoin pulling back too, right? And kind of an interesting spot here, because on one hand, you've got sort of a flag that's filling out here, right? I mean, we've had a big run up, right, over the last few weeks. So you have this flag formation that's playing out. Get rid of this trend line here. So you have that. But if we start breaking this and we take out these lows, this is the 21 weekly EMA, and that is a very big level. That would mean that we come down, probably down towards 55 to 56K. So don't think that isn't possible. It is. If we do that, you want to see it get back up over 60 pretty quick. But I think May is a month you got to be careful, because also too, tomorrow we have Yellen's QRA, right? She's going to tell us how much T-bills versus how many bonds are going to be issued. And the bond part of that's really important, because if the bond issuance grows, markets are going to be under pressure. If most of that's T-bills, less bond issuance, then I think you might get a little bit of a break. But keep in mind, Q3 has a ton of debt being issued. So it's going to be interesting how she tries to thread the needle here, because as you know, Bob, she loves her T-bills, and she's going to try to use that to pump up the markets into the election at some point. But right now it's looking like maybe she's deferring the pump. She's pushing that off closer to the election so she can have a nice run up, make everybody feel good, versus having things fall apart right into it, into that month of November.
Yeah, Phil, it's really interesting to me because, I think October through March was an anomaly. And I think the markets knew they were getting ahead of themselves. And now with all this data coming in, remember, bad news was good news for the market. Now, bad news is bad news. And now they're trapped. Normally Powell would start reducing here, or starting to be dovish to keep everything from rolling over. But he knows he can't. You got the yen collapsing, and you have the dollar skyrocketing, and you have rates going up, and I think everybody's kind of trapped now. Everybody's in the car, and the gas pedal is stuck down, and the brakes don't work. And so whatever direction we're going, we're not reversing from it. And I think things are going to start breaking here, pretty soon. I kind of equate it to being we're going down a hill with no brakes, and the only way you get off is to go on the runaway truck truck ramp, which is going to grind the economy to an absolute halt. And it's ironic because she's complaining about the deficits now, Phil, today after she created these deficits.
Right.
You can't make this stuff up with these people. They must obviously think we're stupid, and maybe they have a point, until we all start waking up from this. Inflation is a very sneaky thing. It's a boil the frog approach by governments, but I think the frog just woke up and realized it's in a pot. And I don't think politicians want to be in that position now where people are starting to grumble and it's manifesting itself now. So with that, guys, Phil, are we going to try to do a live stream tomorrow with the Fed meeting?
Yeah, let's do a live stream tomorrow. We'll start that at, just before the announcement at 2 p.m. Then we'll cover the presser at 2:30.
All right, guys. So stay with us tomorrow. It should be an interesting meeting. Let's just see how far this correction goes. If it's just an excess move, or did we already hit the highs and now we're failing to recapture them? Fun times. Talk to you tomorrow.
Trade Genius.